Tushar Pradhan joins us now. Tushar, good morning. Thank you for joining us. Tushar, some are rubbing their eyes, some are dismissing the market rally, some are questioning the basic role liquidity is playing, but nobody is excited or endorsing the kind of price action we've seen in from the March lows. I mean, the denial mode is, the denial about why markets have gone higher despite weak economic fundamentals, that denial is the loudest denial I've heard on D Street for the longest time.
Yeah, I think I agree with the sentiments because, what we see on the ground, or at least what we appear to feel is on the ground, and what is there in the market prices today, there seems to be a huge difference. We are worried about stepping out of our homes. We are worried about, enterprises coming back to normal. We are even not going to office, many of us. We're working completely from home. We are going to now see economic data, which is going to be significantly worse than ever that we may have seen on a YOY, quarter on quarter, or any basis. And we already know that at the back of our minds. Knowing that, when we look at the market, what else than denial is going to come to our mind? So I think it is very natural to feel this denial. But I think one has to explore the fact that the market is clearly taking a cue about what's likely to happen in the future, which we don't know. And we all know that the market is a forward-looking indicator of what's likely to happen. At least that's what we learned. Which means that we have to explore what has been the reason for these market moves. And this is, remember, not only in India, but it is across the world. And I think this feeling of denial, this feeling of disbelief is pretty much there across most of the stock markets of the world. But I think what we are ignoring is that there is a huge amount of policy action, especially in the US, where we believe close to $1 trillion of this policy action of cash released in the system. It has to find some assets to buy. And I think if interest rates tend to zero in most of the Western markets, I think the logical choice is, and that's reflected in some of the flows that we see in the FPIs, that this liquidity is finding its way into the markets. And probably there is one glimmer of an excuse to say that because of this liquidity, maybe that is what the market is reflecting. But your guess is as good as mine. We are in a state of denial. We continue to, think that this is going to end at some point of time, and we fear working in the markets right now. But that's the present situation. I don't have any other response.
Okay. Now, Tushar, every time I've asked this same question, which in a sense is the big puzzle for everyone, the immediate answer, like you said, is liquidity. So if one works with an assumption that liquidity is going to be abundant, interest rates will lie low for a long time, then what is the end game? Because if markets are going higher because of Fed or because of liquidity, and if that raw material, if I may use the word, or the raw material ingredient is going to be available, so then markets will keep on rising.
Well, that is nothing works to infinity. So there is always a problem there. But for now, I think what we need to understand is that while we worry about the state of the markets, if you break it down in terms of what is really driving the markets, and especially in the US, the case is a little more stark, is that there are certain companies which are going to make an amazing amount of money, no matter what happens on the COVID situation. So just to give you an example, it's a neutral example, Apple Inc., which makes the iPhones, the iconic iPhones, it's likely to make $100 billion of net profit. Now, a multiple of that is very close to $1 trillion, 10 times $1 trillion already. And what do you think in the next few months, a year or so, is going to change that situation in terms of whether they are going to have a difficult time, or the fact that they have even more of that kind of liquidity on their balance sheet? So how do you value a company? Clearly, you are going to give some value to this existing perception of robustness. And if that makes up a very large part of an index, and that index keeps going up because of this, then now you start to build in the blocks to say, well, maybe that is valid. But you look at the broader economy and the large number of companies which are listed, all of them may not reflect that. So I think here, what we are missing here again is that we try to look at a headline. We try to look at this narrow index, for example, the Dow in the US or maybe the Sensex here, and certain components of that index which make it move the way it does clearly make an impression on our mind saying that everything is going up. But I must take your point also that in India, what I have noticed in the last 2-3 months also, that the rally is actually broadening, and it's not really restricted to the large caps either. So the confusion in my mind is a lot more on India. But I think elsewhere it is very clear, that there are companies which, regardless of the COVID situation, will do well. They are adequately and appropriately, I would say, rewarded by the equity markets, and that's where the valuations remain. So your question coming back, will this keep going up and up and up? Well, at least for these companies, for the near term, where they seem to be in a commanding market share position, where nobody seems to be taking any market share away from them. That seems to be the case for some time. Till, of course, something happens where a competitor comes, where the competitive environment changes, where the technology may change. These are things which are in the future, which can always change this picture. Then nothing is permanent. But for now, for the foreseeable future, it looks as if these strong companies will continue to do well.
Sure. But Tushar, just on the subject of the broader market and the outperformance that one has witnessed all through the month of June, so much so that they've managed to outperform the benchmark indexes as well, even though the benchmarks too have had a very, strong rally. We were just digging out names as to what has held out within the small caps. And it's sort of sniffing of exuberance. I mean, the quality of names which is actually holding out in small caps are all the penny stocks. And you don't know why these stocks are up 100, 200% in just 1 month.
Well, you got me there because I am as confused as you are about penny stocks, if you call it, because you don't really look at those. But I think there are smaller companies. I will try to distinguish between good quality smaller companies, which also are in a certain way similar to what is happening in the large caps. So, for example, there are companies which are market leaders in their own space, but they continue to remain, by definition of the market cap, a small cap or a mid cap. And there is no reason for them to continue to gain market share from here, because the rest of the people in that sector are going to be much more challenged. So I think the shift of market cap to the market leader, whether it's a small cap or whether it's a mid cap, is a definite trend that is happening. So I think there is no reason to be worried about that part. But as you say, if there is liquidity, exuberance generally tends to spread. And there may be, examples, as you mentioned, where there may be irrational exuberance. But largely so, I think if you look at the movers, there are some solid fundamental reasons for that. The problem we understand today is that is diametrically opposed to where we see the rest of the economy at. And that's why this denial starts to come in. But if you explore the fundamentals of that individual company, maybe those companies are likely to continue to do well throughout this period.
Sure. Tushar, how is it that you're looking at the move in financials that has played out in the month of June? Again, we were just looking at the futures and options data, and the Nifty Bank itself has had the best series so far this year. And, this is counting pre-March as well. Does it seem like this may not last long because the concern's still prevalent? What perhaps we have seen is just a shot up from oversold levels that played out in financials beginning March.
Yeah, I tend to agree there. There is a little bit of a difference of opinion in terms of where the sector as a whole is going. And within that, again, I think this market leadership, availability of capital, ability to raise capital, I think are very, very critical elements when it comes to financial. So, for example, as people who deploy capital, clearly we are not going to deploy capital in businesses, financial businesses especially, who will find it tough first to raise and increase their asset book, and essentially to raise capital to be able to fund that book. Clearly, we're going to stay away from them because of the expectation of how bad the book is likely to be given what has happened in the last few months, and which is likely to play out in the financial year. So if we as deployers of capital are hesitant, then I don't see why those companies should do well. because of the fundamental problem they will continue to have in terms of the ability to raise capital. But on the other hand, there is a gravitation because as you see, the liquidity continue to exist, the assets continue to remain, but the assets now have to shift away from the weaker players. And now this shift is going to be much more stronger towards the stronger players. So it's going to be an uneven battle where people or companies which have access to capital will raise them at significantly lower costs. See, imagine the kind of yields which are seeing now in AAAs. It's unheard of. And if your demand side picks up at some point of time, which it will, you are going to make a substantial margin. Right? So your net interest margin is going to shoot through the roof. And if you're one of those stronger players and you manage to have your assets, considerably better, then you have a situation where this financial company that I'm talking about, X, Y, and Z, is likely to have lower cost of capital and a higher yield and a growing book. It's almost like a Goldilocks situation. So I think this is where we need to distinguish that to paint the entire sector in one color might be difficult because a lot of these companies in the financial sector are going to face significant problems, down to the fact that their net worth can be eroded if the asset class experience is going to be very bad. But at the same time, one cannot deny of the case that I just explained, where the gravitation toward the strong and the market share leaders is going to actually propel much higher profits, at least margins, if the demand comes back. And once the demand comes back, maybe these prices justify where they are. Of course, it is still too early. Markets are pricing in this if and when scenario. We don't see the demand yet, but as and when the demand starts to pick up is where the advantages will show. And I think that's what price signal might be showing us right now.
Tushar, in a bull market, when banks have raised capital, markets have called it as growth capital. Or, banks are raising capital, price to book will come down and they will lend more. But banks which are proposing to raise capital or which have raised capital, frankly, don't need that capital, whether it is Kotak or ICICI Bank or even, other banks. So can I say that banks, if they are raising capital, rather than looking at it optimistically, one could also say that banks are worried about how NPA cycles would actually start moving, IBC, and again, once the moratorium is lifted. Because if you're raising capital, when you have surplus capital, and when the credit cycle or the credit growth is unlikely to pick up for 6 to 12 months, then one just wonders, what are you trying to do? If you're raising capital, your return ratios will get depressed in the short term, but you're still raising capital.
Yeah, I think without getting into specifics, I will take a hypothetical example. What tends to happen is if you take a manufacturing company, you tend to raise capital ahead of the capacity that you will actually need, right? So you start investing in capacity when things are actually not good because you know that when the cycle starts to move up, it will be too short a time for you to raise the capital, build the capacity, and then start to service the market. So during what we call as lull periods, a lot of promoters eventually raise capital during that time because they know that once the boom starts, once the requirement for capital starts to become so dramatic that the cost of capital goes up, then you will be scrambling to compete with other people who are also facing the same issue. So it is a lot to do with the current cost of capital, the opportunity that exists for raising money now, and hoping that once the demand comes, I will have adequate capital to service the demand. Because at that time, when I find that my capital then starts getting eroded quickly because my asset book is growing fast, then I go into this cycle of raising equity and then deploying, raising equity and deploying. So I think it might be one of those moves where promoters just ahead of time, just ahead of where the demand actually starts to pick up, try to kind of shore up equity in anticipation of future times. One of the other things you mentioned also is in terms of if the NPA cycle starts to pick up, I think equity can also be offset against bad loans eventually. So you will need money to kind of provide for bad loans as they keep coming up. And if at that time you find yourself short of capital and the NPA experience is so bad that you may need to go for equity raising after such an experience, then the cost of that equity might be very, very high. And you will have to probably come at a discount and it'll then become a reverse vicious cycle. So I think these are various reasons I can see, and I think that is pretty valid for certain people to raise money ahead of time. I think it is more of an anticipation of what is likely to happen in the future and what the current cost of capital is now.
Tushar, one final question. The biggest truism in the market, they say, is mean reversion. Why is there no mean reversion which is happening on the upside for deep value stocks and mean reversion happening in highly owned growth stocks or consumer names? When will that happen? We've been waiting and waiting and waiting and waiting. I may add another waiting.
Well, it depends on which part of the cycle that you're looking at. And I think when we talk about mean reversion, one should understand that the mean is that of the entire universe. So if you kind of put little bits and pieces into it, that every bit also should have a mean, then that is unlikely to happen. The mean typically happens over the larger average. So I would think that there will always be cases where companies will be, trading at much lower multiples than the average multiple. There will be a large mass of companies which will be at the average multiple. And there will be some companies which will always trade at a multiple which is higher than the market. Now, there is rotation between this average, but many times we find that companies sustain very high multiples for years and years together. So to expect that they will mean revert because you have this mean reversion in your mind is not likely to happen. And there are countless examples to give. So I think one should be careful about the whole terminology in terms of what mean reversion means. I think mean reversion clearly works in the whole. In the average, it does work. But within that average, these are components which make up the average. And they are not really amenable to mean revert just because you pick up a few set of companies within that or one company to say, oh, this multiple should mean revert, which will revert to its mean. So, for example, if I have a high multiple stock, which, the range of the multiple is between, say, 40 and 80 times, then the mean reversion will happen between those ranges. It will not revert to the average of the entire universe. So I think this is the kind of functionality that we have to look at. And within that, there has been some significant drop in multiples for the more expensive ones. And they are actually reverting back to their mean. So after the big drop, I think that reversion is already happening.
All right, Tushar, we'll leave it there. Thanks so much for joining us this morning and taking us through your views on things as they currently stand.